Hi, my name is John Garvin. I'm the president and founder of benicoltd, an employee benefits consulting firm based in the far northwest suburbs of Chicago. We are pleased to present this video about self-funding as one in a series of videos designed to provide a basic level of understanding around employee benefit concepts and ideas of interest to owners and managers of businesses of all sizes. Self-funding is an employee benefits financing arrangement in which the employer assumes direct financial responsibility for the costs of the benefits paid under the terms of a health and welfare plan. Although there are partial self-funding arrangements available in the private health insurance market for companies with as few as 25 employees, we find that the self-funding of health insurance is really more viable for reasons of predictability around claims from year to year and the much greater availability of stop-loss insurance once an employer has 150 to 200 or more insured employees. Embraced by larger companies and organizations for many years, self-funding is increasingly becoming a popular option for small and mid-sized companies. According to PricewaterhouseCoopers data, the percentage of self-insured employers with fewer than 1,000 people in their healthcare programs has almost doubled, from 29% in 2008 to 48% in 2010. Also, per the 2011 Kaiser survey of employer-sponsored health plans, 50% of employees in firms with 200 to 999 employees are now self-funded. Overall, 60% of all participants in private health insurance plans in the United States receive their coverage under plans that are self-funded. The types of plans that are commonly self-funded include health insurance, prescription drug, dental, vision, and short-term disability. Employer-sponsored self-funded plans typically contract with either a third-party administrator or insurance company to provide administrative services for the plan. Many employers mitigate the financial risk of self-funding, particularly in the case of health insurance plans, by purchasing stop-loss insurance from an insurance company. These policies typically provide for risk retention limitations both on a specific claim as well as on an aggregate claim basis. Specific stop-loss insurance reimburses benefits paid on account of any one individual within the group once the benefits paid exceeded deductible of some kind on a plan year basis. The aforementioned Kaiser survey found that the average specific stop-loss insurance deductible is $78,000 for self-funded firms with less than 200 employees and over $200,000 on average for larger firms. Aggregate stop-loss insurance, on the other hand, provides smaller self-funded companies, particularly companies with less than 500 to 600 employees, covered with cash flow protection. With aggregate stop-loss coverage, to the extent that claims for individuals who are insured fall beneath the plan's specific stop-loss deductible, coverage is then provided in the aggregate for all such claims for the entire plan year. Most typically, stop-loss carriers will underwrite aggregate stop-loss limits at a level that is between 120% to 125% of expected claims. Between specific and aggregate stop-loss, clearly the real insurance coverage is found in the specific stop-loss contract. The point here is that with plans that now have unlimited benefits because of the Affordable Care Act, no small or medium-sized employer can reasonably assume the financial risk associated with an individual catastrophic claim. To this point, most of the time, specific stop-loss coverage premiums will be 10 to 12 times the premiums that are charged for aggregate coverage. That, I would say, is certainly a good indication as to the level of risk between the two types of stop-loss insurance. Self-funded plans are regulated by federal government agencies like the Department of Labor, Health and Human Services, and the IRS pursuant to a host of federal laws, including but not limited to ERISA, the Employee Retirement Income Security Act of 1974, the Affordable Care Act, HIPAA, COBRA, ADA, Family Medical Leave Act, FMLA, ADEA, and a host of other laws. Since these plans are federally regulated, most private sector employers are able to claim ERISA preemption and thereby avoid the state-based benefit mandates that conventionally insured programs are subject to. Depending on the state that an employer has its principal offices located in, this fact alone can account for a fairly significant savings in benefit costs. Summarized, the potential advantages of self-funding are many, and they include: 1, tremendous flexibility in the design of the plan. Second, for multi-sided employers, the ability to offer the same plan or plans in all of the company's locations. Third, The financial benefit realized because of lower than expected claims will inure to the benefit of the plan sponsor and not the insurance company. That's a very important point, I would say. Fourth, lower operating expenses. Fifth, improved cash flow, particularly at the outset when a self-funded plan is implemented. Six, avoidance of state premium taxes, which under conventionally insured plans can raise costs sometimes by as much as 2 to 3%. Seventh, reserves for claims that are incurred but not reported are held by the employer and not by the insurance company. However, in a low interest rate environment like we have now, that's not necessarily that much of an advantage. But again, if interest rates ever rise again, that will become even more of an advantage, as it has been in the past. And finally, eight, again, the avoidance of state-mandated benefits that in many instances can drive claim costs by a great deal. That concludes our overview about self-funding. If you have further questions about this subject or would like to consult with an employee benefits professional about how to incorporate self-funding into your company's overall benefits financing strategy, please give us a call at 847-669-4800. We're really glad you joined us today, and we hope you'll take the opportunity soon to view the other videos in our series around employee benefit concepts and ideas of interest to owners and managers of businesses. Thanks for viewing, and bye for now.